Hi, welcome to the Look Elsewhere effect and survivorship bias. Should you trust this business's stock tips? In this video, we're going to be discussing instances in which seemingly rare events aren't as unlikely to occur as they seem because there are many opportunities for them to happen. Often, we fail to take into account this large number of opportunities and misinterpret some occurrence to be stranger than it actually is. For example, let's say you have a radioactive sample that has, on average, 10 decays per minute. You count the decays for 1 minute and get 22. The number of decays in a given time from a radioactive sample is described by a Poisson distribution. In this case, the probability for you to obtain 22 decays in 1 minute is about 1 in 2,500. So it's fairly unlikely to get this result, and it may seem surprising. But if you repeat the process 1,000 times, it would not be very surprising to get 22 counts once or even twice. In science, this is known as the look elsewhere effect. You may get a seemingly very unlikely experimental result, but if you make many measurements, it might not have been that unlikely over the set of all of your measurements. As another example, let's say there's a lottery with a chance of winning of 1 in 10,000. If you buy a ticket and win, you might think this to have been a rather unlikely event. But if you have 5 friends who each play this lottery every week, it will not be so surprising if one of your friends wins after they've all been playing for a decade. In this video, we'll look at an example of this phenomenon and a related issue, survivorship bias. We'll look at this in the context of a hypothetical example of a business offering financial advice on what stocks to buy. Okay, so there are a couple of concepts that would be helpful to know before watching this video. You can find a few mathematical preliminaries in the video A Tiny Bit of Combinatorics, available on this channel. Also, you might want to be familiar with the binomial distribution. You can learn more about that in the video The Binomial Distribution. However, this video does not assume that you've watched either of those videos. Okay, so let's say you see an advertisement from a business offering to provide daily tips on stocks to day trade. They say that they will recommend one stock to buy each morning, and they will tell you when to sell it later the same afternoon. They claim that over the last month, so 20 trading days, their recommendations, if followed, would have made money 90% of the time, so 18 out of the 20 days. They don't give any other information on their service. There is no information on how they choose these stocks or when to buy or sell them. The question we want to answer is this performance good enough to indicate that their service really works? To address this, we'll first ask a different question. If their system does not work, but instead chooses stocks randomly, how unlikely would it be to perform this well over the last 20 trading days? Then, given that there are many businesses trading stocks in the world, how unreasonable is the hypothesis that someone who wants to offer their services could honestly make this claim even if their system doesn't work? If we tried to answer this in a realistic setting, there would be many considerations to take into account. But our focus here is the look elsewhere effect and survivorship bias. We're thus going to make a bunch of simplifications and assumptions in order to ignore issues that, in real life, we'd have to think about. So it's important to note that the simplifications we're making here make this scenario fairly unrealistic. Okay, so first, the calculation we're about to do has a point only if the advertisement is an accurate depiction of the service. So we're assuming that 18 of their most recent 20 recommendations would, in fact, have been profitable. And we're assuming that nothing nefarious is going on, so they didn't, for example, have any insider information on the companies that they recommended. We're assuming that they really did make 20 predictions fair and square, and 18 of them came out right. We'll also assume you aren't considering any other options for investing your money. We won't assess whether this service is better or worse than some other strategy, but only whether it's better or worse than doing nothing. We'll also ignore any costs associated with using the service, either from the service directly or, for example, from trading fees. It could be that the service's recommendations are profitable, but not enough to offset costs. We're ignoring this possibility. Also, in reality, we would care about the size of the profits and losses, not just how many profits and losses there were. 9 days of profits of 1% per day can be wiped out by a single day with a 10% loss. But this would make our example too complicated for our goals here. So we'll ignore this and take the profits and losses to be all of similar size. This simplifies the problem, but is rather unrealistic. Also, we'll assume that if a stock is chosen at random, bought in the morning, and sold at some specified point in the afternoon, it has a 50% chance of making a profit and a 50% chance of making a loss. And lastly, we'll assume that the movements of the stocks chosen on different days are uncorrelated. In reality, these are also pretty bad assumptions. Prices may be more likely to move in one direction than the other, and correlations are very possible. Okay, now that we've laid out our assumptions, let's ask the following. Let's hypothesize that someone chooses one stock at random each day for 20 days and chooses a time later that day to sell the stock. What is the probability that exactly 18 of them are profitable? The answer to this question is given by the binomial distribution, but we'll go through the calculation here without assuming that you're familiar with that. To answer this, let's first ask a simpler question. Let's hypothesize that someone chooses one stock at random each day for 20 days and chooses a time later that day to sell the stock. What is the probability that the first 18 stocks chosen are profitable and the last 2 are not? Okay, so the probability that a given stock goes up is 50% or 1/2. We take the movements of the stocks on different days to be uncorrelated, so the probability that the first 18 stocks are all profitable is 1/2 times 1/2 times 1/2, etc., 18 times, which equals 1/2 to the 18th power. Now, the probability that a given stock goes down is also 50% or 1/2. So the probability that the last 2 stocks go down is 1/2 times 1/2 or 1/2 squared. So the probability that the first 18 stocks go up and the last 2 go down is 1/2 to the 18th power times 1/2 squared, which equals 1/2 to the 20th power. Okay, so the probability that the first 18 stocks go up and the last 2 go down is 1/2 to the 20th power. But we want the probability that out of the 20 stocks, 18 go up and 2 go down. We don't care which 18 go up and which 2 go down. So we need to figure out how many different ways that could happen. Okay, so let's enumerate the ways in which we could have 18 stocks go up and 2 stocks go down. So out of the 20 stocks, it could be that the first and second go down, but the rest go up. Or it could be that the first and third go down, but the rest go up. Or it could be that the first and fourth are the ones that go down, or the first and fifth, etc., all the way up until the 1st and 20th. That gives 19 possibilities. It could also be that the second and third are the stocks which go down, but the rest go up, or the second and fourth, or second and fifth, etc., all the way up to 2nd and 20th. That gives another 18 possibilities. We can continue this process all the way up to the 19th and 20th stocks as being the ones that go down when the rest go up. That's the last possibility. There are a few ways you can calculate the number of ways to choose 2 objects out of 20. For this example, it's not too hard to just add up all of the possibilities by hand. If you'd like to know more generally how to do these calculations, you may wish to look at the video A Tiny Bit of Combinatorics, available on this channel. Okay, so there are a total of 190 different combinations of the 20 stocks where 2 go down and 18 go up. Each of these combinations has the same probability of occurring, 1/2 to the 20th power. So the probability of having any 2 of the stocks go down and the other 18 go up is 1/2 to the 20th power times 190, which is about 1/5519. So if the 20 stocks are chosen randomly, the probability of having 18 of them go up and 2 go down is about 1 in 5519. This seems like a rather unlikely event, so we might conclude that this business isn't choosing stocks randomly and knows what it's doing. But now we can ask, how many businesses are there advertising advice on buying and selling stocks? How many chances were there for this to happen? Actually, answering this question would be non-trivial, and we won't try to do it in any serious way. We would probably want to estimate how many of these businesses advertise where you'd be likely to see their advertisement, what fraction of businesses would run an advertisement like this one, etc. But it's reasonable to suspect that the number of such businesses is not small. Furthermore, assuming that businesses advertise honestly, businesses who have not had performance this good would not claim that they have. So if there are many businesses with strategies that don't work, only those who by chance have had good performance would advertise their performance. This makes it harder to estimate how many relevant businesses there are. We don't see the ones that aren't surviving the test of good performance. This is thus an example of survivorship bias. Only those businesses with good performance advertise their performance. If we tried to come to conclusions about the performance of these types of businesses in general, we would likely be very wrong if we only included those businesses advertising their performance in our sample. Additionally, we can also think about just the one business we saw advertised on its own. This business is only describing their performance this past month. Let's assume this business has existed for several years. If so, the business has had many months, perhaps 50 or 100 or more, in which to measure their performance. Presumably in other months, if their performance is not as good, they don't run this advertisement. So if we only consider their performance in months where they run this ad, we may get a very skewed idea of how well their trading advice actually works. So the probability that we calculated of having 18 out of 20 stocks be profitable, so that was 1 in 5519, might not be as impressive as we thought. Now, we definitely have not shown that this business doesn't have a working strategy to pick stocks. We've just seen that evaluating whether or not they have a working strategy is harder than it might initially seem. Okay, so let's summarize. In this video, we've seen that seemingly unlikely events can occur more often than we think if we fail to take into account how many opportunities those events have to happen. One way this manifests itself is as survivorship bias, where we, perhaps unwittingly, only take into account events which have passed or survived some kind of test. If we don't take into account events which did not survive the test, we can come to wrong conclusions.